Welcome to Connecting the Dots video series. My name is Ron King. This is video 2 of 2, where I discuss the book, The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness by Morgan Housel. In the first video, we discussed the first 10 chapters shown here. In this video, we'll look at the second group of 10, going from chapter 11 to 20. And the framework we used is reproduced here. And it basically has on the horizon, on the horizontal time, where we have the past, the present, and the future, and on the vertical axis, the events, perceptions, and actions, and the decision variables that the author relates to most closely are savings and investing. And to get a coverage of the framework, go back to video 1. So we're now looking at chapter 11, reasonable relative to rational. And the author's takeaway from this chapter, I think, can be summarized with this quote: "Do not aim to be coldly rational when making financial decisions. Aim to just be pretty reasonable. It's more realistic, and you have a better chance of sticking with it." In some sense, what the author suggests in the chapter is that we can suffer paralysis if we're so focused on doing the best thing and trying to optimize when we hear so much about things that can go wrong. And he's basically saying, don't try to do anything fancy, be relatively straightforward. And one of the things related to that is to buy an index as opposed to selecting particular stocks. Now, he isn't opposed to selecting particular stocks, but have a strategy that you can stick to. Chapter 12, surprise. In this chapter, he discusses elements of what we should expect in the future. So this is the mindset we have as we look into the future. And a quote that I think captures the essence of this chapter is, "Things that have never happened before happen all the time." So if we look at the range of outcomes in the past, so let's say it's this range from the high to the low, and we project that to the future, what he indicates is that things outside that range happen all the time, and one should be aware and build into their models this expectations. Chapter 13, room for error. What he's thinking here is that if you have a plan, which you should, expect the plan not going according to plan. And to deal with this, he suggests that we have a cushion with dry powder so that if things don't go right, we have another play at the game, that we want to be able to survive bad outcomes so that we can stay in the game. So basically, room for error relates to having the surplus so that you can absorb some of the downside. 14 is a very interesting chapter on you'll change. And the idea here is that planning is hard because over the long term, your goals, your desire change. And I think this is a very important philosophical concept. I won't go into detail here, but I think one could spend a great deal of time thinking about the reality of how we think about ourselves today relative to what we might be in the future. And the end of our planning horizon gives us the sense that whenever we look back, we say, oh, wow, we were different in the past. But when we look forward, we don't make that same assessment of saying, if I changed a lot in the past, will I change a lot again in the future? So a very interesting chapter. I think you'll enjoy it. Chapter 15, nothing is free. And I'm going to introduce some finance here that he doesn't use, but I think is the basis for his thoughts. That if you think about a risk-return trade-off, as discussed in traditional finance, can be captured in this graphic here, that on the horizontal, we have volatility, which is a measure of risk, and on the vertical, expected return. And what we see is that our expected return goes up as our risk goes up. So if you want to bear the burden of something more risky, the modest risk and fixed income versus property, real estate maybe, and Australian shares and international shares, the more risk, the higher return. And the argument of the efficient frontier is you should always make sure that if you absorb this amount of risk, that you get that expected return. And the idea here that he's making, although he doesn't use this graphic, the quote here captures the essence of this chapter is thinking of market volatility, again, that's this axis here, should be thought of as a fee rather than a fine. And what he means is if we invest in something risky and we have a high return, high expected return, and if it turns out low, we shouldn't consider it like we made a mistake, this was a fine, this was a penalty. Rather think about it ex ante, that it's a fee. If you want to play in a game of high risk, you've got to expect that you're going to pay these fees. So it's simply a framing issue. Frame the downside as a fee, as opposed to a fine. Again, this is a psychological basis, interesting point of view on his thought process there. You and me, and again, this is a finance topic. He doesn't go into the traditional finance story. I'll just spend a minute here. The way we think about this in finance is market efficiency, and that relates to that if there is a stock price that moves up and down, that at any moment that stock price captures the best information that everyone has, that it's an aggregation of the knowledge and the expectations for the future of the stock price at any point in time. So we think of this prices, equity prices are a function of the economics, the underlying reality on Main Street, the story the company has, and momentum. And that, stocks tend to, if they're in movement up or down, they continue that momentum. But in reality, the stock prices may be subject to error. And what his take is, beware taking financial cues from stock price, for example, from people playing a different game than you are. So the idea here is if you're a long-term investor and you expect to hold your investments for 10, 20, 30 years, but the prices are set by people who are day traders, he makes the case that day trading prices may be very inappropriate for you to make long-term planning. So I'm not sure how you might take this suggestion of his and turn it into action, but basically the inference I would apply to this chapter is that you might assume market efficiency is not at a high level. So in other words, simply because you see a stock price is at a certain range, don't assume that they who are setting the price know something you don't. And the reason being because your time horizon might be very different than theirs. The seduction of pessimism. He quotes Deirdre McCloskey here, who's a well-known economist and sort of a world philosopher. And Deirdre says, for reasons I have never understood, people like to hear that the world is going to hell. So he said, when you set your expectations, you can be optimistic or pessimistic. And when you set your aspirations, you can be modest versus aggressive. And his recommendation, again, somewhat of a personal choice, but he makes the case that one maybe sleeps better by having this, is be optimistic, but have aspirations that are modest. Don't have the get rich quick mentality. Chapter 18, when you believe anything. And this is a chapter that really is based in psychology. And the quote that I think captures the real fundamentals of this chapter is, the more you want something to be true, the more likely you are to believe a story that overestimates the odds of it being true. That's the old adage, I wouldn't have seen it had I not believed it. And the basic idea here is we suffer from confirmation bias. When we look out in the world, we see what we want to see to reinforce our beliefs. And this is so true. So when you're looking into the future, thinking about the future, be aware that your psychological point of view is going to work reinforce what you want the world to be. Chapter 19 is a summation chapter, and he puts it all together, and he's going to talk about 14 different concepts. So, some sense, think about chapter 19 as a summary. I'm going to go through these quickly, but provide each one so you can see how this reinforces the previous chapters. First one, go out of your way to find humility when things go right, and forgiveness, compassion when things go wrong. And this goes back to this idea we talked about in video 1, that your decision can be good or bad, and the outcome can be good or bad, but you can't tell really if you get a good outcome if you were lucky, or if you get a bad outcome, you just had risk. So he said, don't over congratulate yourself if you've got good news, or beat yourself up if you have bad news because of the uncertainty associated with any decision and the outcome of that decision. Less ego, more wealth. What he basically says is, again, something we discussed in video 1. Cars and houses may signal to others you're rich, but what you should do is focus on wealth, things that people can see, cash, and investments. So keep your ego out of it. Put your savings into things like investments. Number 3, manage money in a way that helps you sleep at night. And this reinforces, have a cushion, have enough cash so that if things go wrong for a period of time, you can weather the bad storms. 4, if you want to do better as an investor, the most powerful thing you can do is increase your time horizon. And we talked about this in video 1. And again, the point of this graphic is, if you start investing early, then throughout the life that you live, your money will work for you. So strongly encourage the idea of early investing. Become okay with a lot of things going wrong. And we talked about that again in video 1, where there's a small probability of getting big outcomes, big returns, but the meat of the distribution, so this is the log normal distribution that roughly characterizes stock returns. Most stocks don't do well, but the 7 to 10% that do well basically carry the whole portfolio. So things are going to go wrong, but if you have a diversified portfolio, you'll get a taste of this entire distribution, which should give you the expected returns that one would hope that allows you to build wealth. Use money to gain control over your time. That's a very interesting thing. He doesn't justify that, but Warren Buffett, who he doesn't quote here, this is my reading of Warren Buffett, really makes the point that invest in yourself first. So Warren Buffett says, invest in yourself. The author here indicates that take your money and invest in investments first, so you can decide where in your life cycle you are to determine which of those two you might prioritize. Be nicer and less flashy. The book is about the financial life philosophy where you save and invest. And the idea, if you save and invest properly, you increase happiness. And sure, I think it's sort of a real good fundamental aspect of life. If you're nicer, people are going to be nicer in return, and less flashy. That is, you don't have these symbols of being rich, the houses, the cars that you use to impress others. You may, in fact, be happier. But again, this may be fairly idiosyncratic to individuals. Save, just save. You don't need a reason. So he's saying, if you think about your income statement, don't fixate on the top line as much as manage your discretionary expenses. Live within your means. And then when you invest in indexes rather than the showy objects of cars and other trappings. Find the cost of success and be ready to pay for it. We spoke about that earlier. On this efficient frontier for the risk return, if you're going to take investments that are very risky, be ready that you're going to have times when you have to pay that fee. Worship room for error is number 10. And here he's basically saying, have a cushion. Again, it's a conservative investment strategy. Have enough money that's a dry powder. So if things go wrong, that you can stay the course. And of course, it's easy to say for people who have the discretion and the financial slack to be able to amass some of this dry powder, but this is the advice that he gives. Avoid extreme ends, and we don't mean extreme ends of buying companies that return a lot or little, but basically diversify. You should like risk because it pays off. The more risk, the more return. 13, define the game you're playing. So I created this framework, and this is my interpretation of the concepts he has. It's not the way he has delivered the concepts in the paper, but really the way you form a worldview and your model of the future and expectations certainly going to define this savings investment strategy. And I strongly encourage you to think about this income statement and balance sheet way to think about it. And then finally, respect the mess. Things are messy. So to the extent you can, talk to others about these concepts. Be thoughtful in how you proceed, but don't be paralyzed. I've been in finance for a long time. I understand the frustrations of things changing, and you get experts on all sides of these matters. Some say buy, some say sell. The advice that the author gives in this book, I think, are very good. Try to minimize your expenditures so you live within your means, and save on diversified index. And to that end, in chapter 20, he calls it Confessions. He basically talks about his way of investing, his financial lifestyle strategy. And he starts out by saying, how my family thinks about saving is this. We got the goalposts of lifestyle desires to stop moving at a young age. So we talked about this in video 1, where if you want to amass some wealth, don't try to compare yourself to others who maybe have great wealth and can have flashy things to indicate that wealth. Stop your goalposts so you are not on this hedonic treadmill where no matter what you get, you always want more. So he said as a young person, he and his wife agreed they weren't going to get on that treadmill, always trying to keep up with the very well-off neighbors. Every month, the author says, he and his family invest money into Vanguard index funds, which again is a whole distribution across the market. Very good advice. Sleep well. It's very simple. Vanguard is a company that has low fees, so a very good strategy for building a discipline of investing. And finally, all of our net worth is a house, a checking account, and some Vanguard. So very, very simple financial set of assets. And I admire that. I think that is a way to simplify your life. So in 20, he basically talks about the way he organizes his financial life. And I think this really adds a punctuation mark at the end of the book, where he closes the book by saying, here's all the advice I give you. I live this advice. So this brings us to the end of the video here. So in video 1, we covered these chapters. You can find this video linked below. And in this video here, video 2 of the 2-part series, we talked about these. I didn't talk about the postscript in the book, a brief history of why the U.S. consumer thinks the way they do. It's very interesting. It doesn't really relate to the psychology of money, but it basically says, why is it that we have the beliefs as a society that we currently have? So this brings us to the end of this series, Connecting the Dots, with our discussion on this, the psychology of money. I highly recommend this book. I think it's clear, understandable, and actionable. Thank you for your involvement. Look forward to our next video.